So if you're a Tesla investor, you might be asking yourself, how are the institutional investors thinking about Tesla and specifically the coming Q3 earnings call this week and the rest of the year? Well, Adam Jonas of Morgan Stanley held a lunch meeting with a number of bulls and bears to get their thoughts. Most were not optimistic about Tesla growing earnings at all for 2024. Most were not excited about the Cybertruck, nor Dojo, and Tesla's AI efforts. So today, let's ask Jeff Lutz what he thinks, his thoughts on all this. So Jeff is a ex-supply chain C-level executive at many Fortune 100 companies like Lenovo, Google, and Motorola. He's currently running his own consulting firm. Welcome, Jeff.
Great to be with you, Herbert. Lots to talk about.
This is a big one. We love it whenever we see Morgan Stanley and institutional firms, and I love it when I get your feedback on these topics. So this weekend, or it was actually last week, Adam Jonas had a meeting with a bunch of other institutional investors, and he had his lunch, and he wanted to get from them their sentiment of what's happening. And right now, the kind of overall reaction is that the sentiment from these investors around this upcoming Tesla earnings is that it's going to be very cautious. Many are wondering if Tesla can even grow earnings at all in 24. And then they think that the Dojo and AI is so difficult to quantify, and they're just ignoring it right now. At high level, what do you think, Jeff?
Yeah, I like the fact that expectations are. I actually can't remember expectations being this low coming into an earnings, and I do think earnings are going to struggle in terms of the quarter that's being reported on. But I do think the story is going to be about how the company, the kind of the mood the company sets and how they guide. Elon has said for, over a year now that, this would be a difficult period, but he sees it improving. I think he said in the middle part of 2024. And when you think about that, you think about, what's going to be happening during that time period, by then, the Model 3 refresh should be in full distribution. The Cybertruck should be on its way to full capacity and just out there in the wild, for sale, and the Model Y will continue to grow in its dominance as being the number one selling car. And the question's going to come down to is, what does Tesla have to ultimately do in that climate in order to to keep that momentum going? Are they going to have to do more on the MSRP side? And what I've been telling you on, and telling the group here for a number of months is that in the second half of this year, and, it looked like it's going to be more towards the end here, obviously, that there's going to be a point in time where Tesla's ability to reduce COGS is going to exceed how much MSRP reduction or pricing reduction that they have to do. So, we can step through this article because it kind of really gets to, Morgan Stanley's expectations, and it also kind of assesses the sentiment of the group in the room. But I think it's going to be this earnings call. It's going to be in 2 days from now. I think this is going to be kind of a mixture of, all right, this is what happened in this current quarter, but looking ahead, this is what we're excited about. And I think it's going to really be about also guiding and holding to the 1.8 for the year. And if there's anything that they can say about the following year, that would be interesting. And then finally, the other thing to look forward to next year are these larger catalysts. In what I believe is that in the very near term, an FSD partner, a license partner, would be announced in that time frame as well. And that is going to be, depending on who the partner is, and depending if it kind of mirrors or models what happened on charging in terms of others, that could be the start of something very big for Tesla.
Yeah, I think that's the biggest difference, is that institutional firms don't add any of that potential at all. They're just strictly focusing on what's been announced. So let's go through the key takeaways from that lunch. The first one is that, unanimously from that group, they believe that there's going to be earnings revision on a downside for the remainder of 2020, for the remainder of this year, the next quarter. Secondly, they think that the Tesla share price might also be cautious, that it's going to be going down. But they did say that they're less pessimistic about the Tesla share price versus the market over the next 12 months, and they think it's probably hold its own for the next 12 months. And then just like you were saying, commentary on the forward outlook, that's what's more important for them. That's more consequential than the 3Q earnings result itself, which is great, right? Because we don't, it's already built in. The Q3 results are already built in. So they're just waiting to see what are they going to say for the future. Any comments on these three high level takeaways?
No, I mean, I think we hit most of the
Yeah.
points. It's really about, uh, what Tesla says about the future. And the other thing about next year that should be very interesting is the macro environment. And some are estimating now towards the middle part of the year that we would start getting some guidance in terms of, either being finally paused or definitely starting to cut from a rate perspective. And that will be met. There's going to be the absolute, like, how much are they actually cutting? But just the fact that the Federal Reserve starts to ease up on rates, that will be seen. What will happen is investors will look ahead, the next 12 months from that point. Say we're in the middle of 2024, they're going to look, okay, now we're in a climate of rates easing versus rates tightening up. And right now we're in this kind of this indeterminate period. It may go up another quarter point. It's not a big deal, but maybe it's higher for longer. But by that point in time, in the middle part of next year, we should know, we should have really good guidance. Either we're cutting it by that point, or it's gonna imminently occur. And I think that's another big factor. Again, to the auto market, and Tesla will be weighed down by what's going on in the interest rate markets. And they're at multi-decade highs at this point.
Exactly. Exactly. So, I mean, this is the fun part is right now we have been going through the last 2 years the worst possible scenario with the macro the way it is, interest rates being crazy high as it has been. So if we can get past this year, things are going to turn around and look positive. But as you'll see here, the institutional investors still see Tesla as a car company, and they still think it's going to be weighed down. They don't include macro. They don't include the other businesses that could turn around Tesla quite easily and quickly. So let's go down the list here. Number 4, they think that fiscal year 2024 is going to be volatile, downside risk of volume sales. So they're not confident they're going to hit the volume numbers for next year. And some think earnings potential may not grow at all. The Cybertruck, surprisingly, there's very little enthusiasm from the institutional investors versus unanimously from the retail investors. We all believe that there's going to be kind of the halo effect of the Cybertruck. These guys are very cautious. They think that there's teething issues. You've talked about this, that it may take them longer to ramp and there's going to be delayed. And Tesla will be seen as continuing to resort to price cuts. So if the Cybertruck doesn't seem to be progressing, I'm not sure how you connect the two together, but that's where they're concerned about, more price cuts. If Tesla announced a launch event, start of production with the third quarter results this Wednesday, this could be seen as positive for the stock. So far, no news. And so they're very cautious about it. And then this one is very disappointing. Really not much interest at all in Dojo, despite the fact that Tesla has it's going to have 3 largest supercomputers in the world. Tesla's AI or FSE efforts is they think it's difficult to predict the path, hard to measure any improvement of version 12. And there's a general concern. They still have this concern that Tesla's approach with vision only, it's risky. They still haven't bought into that. Thoughts on any of these 3 topics?
Yeah. So on let's take them. Number 4, downside risk to volume. It's downside risk to what they're forecasting, not downside from 1.8. And that's going to be a question, continually from Tesla until they get these new models out and they get them out in volume and they guide for where they see themselves next year. But I actually find that hard to believe, given the IRA credit is in the US, which is one of Tesla's largest markets. That's moving the point of sale for 96% of what they build. I find it hard to believe that that they're going to struggle to hit volumes. But obviously, there's 2 other regions, Europe and China. But that's where the new Model Y, the slight changes to the Model Y, and then the big refresh on the Model 3 should help. So I think that's what they're talking about. Number 4. Number 5, I've been telling you and telling the audience about Cybertruck and about this thing being a little bit difficult, this having this confined list of engineering issues to solve to get this thing into mass production. I think it's going to be a difficult product to start, but once the team this is the difference. I think once the team works through these issues, I think it's going to be actually a very high gross margin vehicle to build. Just when you look at it fundamentally in terms of reduction in component count and the margins and the premiums that truck buyers put on their products and what they sell for. So these are the existing ICE variants are very high gross margin vehicles for legacy auto, and consumers of these products will pay for it, and they will also pay for the accessory side of it as well. So I think it's going to eventually be a high gross margin product. Again, I think the theme here is going to be just to fast forward, not even a year from now, into the second quarter, even the beginning of the third quarter of next year. You're going to have a Cybertruck in meaningful volumes and coming down its going up its gross margin curve, coming down its COGS curve. Its COGS right now are the worst it will ever be in the history of that product. Probably a bit so in Q1 as well, but they're going to work through those issues. And as soon as they get all the machines up, the capacity utilization up, they get the labor up, they get everything closer to utilization rates they want given the current capacity, they get the yields up. That's the other thing. You can get all the capacity up in the world, but you've got to be able to move product through at high yield. Yield is passing product through the factory, good quality product through the factory. And as that happens, the COGS are going to come way down. By the way, again, Tesla has the ability with their supply base, with what they have with Model Y, which is the number one, the highest volume vehicle in the world. They have tremendous leverage in their supply base. However, it is difficult and it's somewhat unfair, and I don't view Tesla doing this with their suppliers, to take leverage over your supply base when they're struggling with yield of components. So the supply base also on Cybertruck has to get up, to their full rated speed. And I think they are, and I think they will. But in that period, that's going to be the difficult period for COGS and volume. So that's why number 5, they're not as excited, because they see this mixture of COGS being high and volumes being low. The announcement kind of seemingly not maybe pushed out, depending on what you view. I mean, Tesla did in the last earnings say this, we will be putting this into production in Q4 and delivering the vehicle. They didn't say what day in Q4, but some are perceiving the fact that we're in mid-October now as a bit of a push. And then number 6 quickly on Dojo. It's going to come down to money, and it's going to come down to how does Tesla tie having the world's biggest supercomputer by the end of next year to money. And I think this is where the FSD licensing piece comes into it, because part of that's going to be is hosting this data, this training information, and being able to support a network, and not only a Tesla network, but a multi-OEM vehicle network, and being able to process all of this training data and then convert that. I think the way to monetize this is when number one, FSD take rate will go up as a result because it's working better, V12. And then eventually, once V12 is actually working, I think now a robo-taxi fleet can be on the horizon. Because I don't know, sometimes I actually get a little bit concerned that people are looking at robo-taxi first without having the FSD, running. So I think that's what number 6 is about, is monetizing. Where's the money come from Dojo? And I think it's going to be the licensing. It's going to be getting FSD take rate up because it's performing better. And then it's going to be, now the robo-taxi fleet will be on the horizon. Next, I'm not predicting a robo-taxi fleet by the end of next year. I'm not one of those investors that are predicting that, but I think it should be on the horizon if V12 is out there running the way it should be, and you've got licensing agreements. Well, the next logical thing is, getting a fleet of robo-taxis going. So 2024 is actually going to be quite the exciting year for the company. I've never been more excited, actually, as an investor.
this is the difference between the retail investors versus the institutionals. They will just say, I don't know, cautious, be careful, who knows? And then we are saying, okay, it might be delayed, but once it gets past the Cybertruck scaling, once we see the FSD 12 improving, we're going to get there. But they won't even put any numbers, and they'll just be very cautious about it. So let's get into Morgan Stanley's own estimation of what to expect for the third quarter results. We already know that the units of vehicles delivered will be 435,000. They forecast the revenue. Now, Jeff, they put ATP. I'm assuming that that means average sales price. Was that a mistake? Or is there
Transaction price, yeah.
ATP versus ASP versus ATP? Was that a mistake? But they're saying it's 44.5 thousand per unit, down from 45,000 in second quarter. And then the gross margins is going to fall, they believe, to 17.5% in third quarter versus 18% in the second quarter. And then the operating margin will also fall to 9.3% versus 9.6%. And let me just finish this off and get your feedback on this. But the earnings per share, they think it's going to be 56 cents versus 78 cents the second quarter. And then now the consensus, though, from the other investors, they think it's going to be 65 cents. And so they also estimate a reduction in earnings per share. And then, of course, the cash flow is going to be at $1 billion, which is another kind of like flat or lower than it was last year. And of course, they just think about the forward outlook is what matters most, is what they're reiterating here. Thoughts on these numbers?
Yeah, let's go back to this slide here. Here's a couple things that stand out. There's things I agree with here and things I don't. So the ATP being down $500 from the prior quarter, I would think it would be
What's
down
ATP,
more.
Jeff?
The average transaction price.
Okay,
So
so
this
instead of
is
sales price? Mm-hmm.
yeah. So think of the MSRP as Tesla's got a $43,000 $900 Model Y rear wheel drive, but then
Sticker
people
price,
add
yeah.
the charging cable, then people add
Gotcha.
right seats. They
Yeah.
add so anyway. So this is
Okay.
taking all the vehicles they sell divided by the transaction price. I would think it'd be down a little bit more. Remember the chart we went through last week on COGS, and that was the data was from Troy, and I agree with the data. And in that one quarter from Q1 to Q2, I believe Tesla reduced COGS by $1,200. So the fact that they only see ATP coming down, $500, I find that interesting. I think it would be down a little bit more with all we had inventory. So we had inventory reductions, and we had the configurator, reductions in China. But let's see where that comes in. The gross margins, they have it, falling like 0.6%. I agree with that. I think this is going to be a messy quarter. They had to ship through. Let's talk about the inventory for a bit. So everybody's worried that only 5,000 net units changed in inventory, but I think the inventory changed meaningfully because in the data, and this is maybe Tesla will get into this, probably not unless they're specifically asked. But you have to get into how the inventory turned. Now we know they built somewhere on the order of 18 to 20 some thousand Model 3 refreshes that they built them, but they could not sell them to customers yet. They weren't approved for sale. So that's going to be in the inventory. And they told us that half their inventory, roughly 45 to 50,000 is in transit, and the other half was static and available for sale. So when you start taking that 18K or to 20K Model 3 out, now a big portion of the inventory turned because it's not regular Model 3 or something else. And then half of it's in transit is what they're running. So I guess what I'm saying about Q3 is they probably burned through a lot of the product that was built in Q2, which would be at slightly higher COGS than in Q3. So again, I agree with the gross margin take, probably being down a little bit more, but I do think this starts to stabilize between Q3 and Q4. Again, unless if what they did in the configurator for Q4 and basically over a week ago, maybe almost 2 weeks ago, if that's it for Q4, then I strongly believe that gross margins have stabilized in the quarter, because that was what they did in Q4 for the 2 Model Y trims in North America. Nets out to a $400 a $400 change in selling price of the vehicles across the fleet. Sorry, across Model Ys across the fleet, and that's again that's 2/3 of their volume. So in summary, I think the average transaction price may be down a little bit lower. I think the gross margins are probably down a little bit, and Q3 is going to be a very difficult quarter to call, but I think it stabilizes definitely on the margin side for Q4. Again, unless there's some massive change in MSRP. I think Tesla made the moves that they wanted to make for Q4, and they have the new Model 3 coming out. So let's see what happens.
Okay. So investor segment, this is from Gary Black, and he's just repeating what he heard there. Investor sentiment is fairly negative going into this week's third quarter. He believes that there's going to be more price cuts likely in 2024 if the Cybertruck doesn't ignite interest in Tesla franchise. Actually, Gary is very, very optimistic about the Cybertruck. So he says we remain bullish about the Cybertruck. Many of the Morgan Stanley clients are questioning Tesla's earnings can even grow in 2024. And then so Gary's forecasting 2024 volume growth of 40% to 2.5 million from the 1.8 million, and the earnings per share growing 40%, 39% to 460. Huge difference in sentiment between retail investors who are overwhelmingly supportive of management's decision to cut prices and institutional investors who seem mostly against them. I don't know. That's a loaded question there. Yeah, that's a loaded question there. You got to cut prices when you need to. And then there he's saying that retail investors ignore the comments by management that that they will cut prices when they need to, and they get a daily kind of report. Elon was saying, and they're gonna react to that daily report. So that's why they are cutting the price. And then
let's talk about that.
Yeah.
Let's talk. One of the things that this is a big difference between Tesla and legacy. So Tesla has 15, I told you about 15 days of inventory. Again, about half of that is in transit. So basically, product they're building and shipping, it's being sold through in a week or two. Their inventory's turning pretty rapidly. So what they're getting is they're getting faster sales data. If you look at if you were to make a chart and just put the legacy OEMs in Tesla, and you look at the length of their supply network and their distribution network, it's going to take legacy probably a month or two, maybe longer, for them to have the understanding and based on the latency of their data and the length of their inventory to get the kind of information that Tesla is getting. So Tesla's seen this tightening throughout the year, and quite frankly, they have their product at very high pricing relative, to COVID. But Tesla is going to see things. Tesla is going to see the reaction to interest rates. They're going to see the reaction. It's not only interest rates; it's the consumer and how much money they have available to spend. They're going to see that much, much faster. So they're the actual canary in the coal mine as it relates to the auto industry. And I find that point interesting because I think coming out of this UAW strike and going into the following year, so we're going to go into the next year, and this is the landscape. And then we're all talking about 2024 now in context with this note from this tweets from Gary. The other side of 2024, let's talk the US. The rates are still going to be elevated. They're going to come out of the UAW strike with elevated, OPEX, elevated COGS to build each vehicle. They have most likely, Ford's already announced that they pushed their capacitization efforts for EV out. Remember, they were targeting 600K by the end of the year, this year, and they've moved that out to an indeterminate date in 2024. GM hasn't formally announced anything, but they're most likely what they're going to have to do is they're going to have to tighten up on capital because they have to move more money into labor. And this will actually, play. Now you look at the other side with Tesla. And by the way, sorry, before we leave legacy, and they're leaving the year with elevated pricing and elevated inventory. Their EV inventory in Q3 was somewhere between 97 to 111 days of inventory. They started the year with about 50 days of inventory in EV. So they started the year with enough inventory based on how fast they were selling, again, to very low sales, but that's days of inventory. So their legacy is going to leave the year with elevated inventory, still elevated prices of their vehicles, and high interest rate environment. Tesla's going to go into the next year, IRA at point of sale in North America, lowest pricing that they've had since basically the launch of their vehicles, highest volume that they've ever had since the launch of their vehicle, and lowest COGS since they've ever launched the 3 and Y will be at that point in time. So if you compare and contrast the two, Tesla does have competition, and this is how they're going to compare going into 2024. So sometimes I don't think the analysts actually look at it. I think Jonas does, because he does talk about capital tightening for EV on legacy, but sometimes I don't think we compare and contrast the two. We just look at Tesla earnings in isolation. I do think the earnings story for Tesla is going to be a different story. I think they're going to be coming out of this interest rate malaise, this price cutting malaise, faster than legacy does, just based on the inventory situation.
Okay. Let me just sum it up. I think I think all of us, both retail and institutional, we don't think that there's going to be a surprise on the Q3 call on Wednesday, but we have a different opinion in terms of what we're thinking is going to happen in Q4, but more importantly, 2024. They just don't even put any kind of expectations for Cybertruck. Yes, it's going to be slow at the beginning, but then it'll scale by the end of 2024. The volume growth, that is pretty sure going to happen despite price cuts may be happening. And then, of course, FSD, robotaxi, bots, all that's going to continue to improve. So you folks, you got to be following Jeff. He just drops bombs and information like this everywhere. He's on X at the Jeff Lutz. Give him a follow. Thank you very much, Jeff. Talk to you soon.